Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble.
Is this working? Test. This is Keith every Thursday when we're recording. Just want to thank everyone first and foremost for coming out. The support is very truly humbling, and people have come far and wide across the country, so we definitely appreciate it. Also want to thank our sponsors, BMO ETFs, Canadian Western Bank, and Greater Vancouver Tenant and Property Management Ltd. Very good people that have made this event possible. So let's jump into it.
Hello. We didn't do a mic test.
You want to test that, Boomer?
Yeah, we're ready to go. So what you guys don't realize, we do this every week on the Zoom, I think it is.
On Thursday.
Steve always, we're looking at each other and we get it going, and he always says, hey, how was your week? What was going on? And with coming to Vancouver, obviously we're excited to come out. But I kept saying to Steve, send me the list. I want to see who's coming. I might know a few people. So, finally after asking him 8 or 9 times, he sends the list because Steve struggles with technology sometimes. And I get the list, and the first name I see on it is this guy, Keith Acton. And I'm just so excited. I called Steve immediately, and Rich, I said, Keith Acton is coming. He said, yeah. And I said, he played in the NHL for 16 years. He played with the Oilers, the Canadians, I started going out to the whole list. So excited to meet Keith Acton. Then Steve says to me, he goes, Keith, it's not that Keith Acton, it's Keith Acton, my accountant.
I should add Keith Acton, our accountant, who now runs some of the Loonie Hour media's accounting. So Keith, I think, who's actually here, ironically enough, we do love you. What? So we got the Boomer all the way from Halifax. What's going on?
Is your mic working? That's the other thing we always do. We make sure that the Boomer's mic is working because it never is.
Yeah, Keith, the Pinot Noirs were flowing last night. We went out for a nice dinner. You put me in a spin cycle last night.
And then we wake up this morning and we had, when we first scheduled the event tonight, you have no idea what's going to happen in the markets. And the fear is that there's nothing going on. So then we had to listen to Rich give us some, very exciting data points that doesn't matter on a lot of things. But yeah, it's going to be a really good conversation tonight because over the last 48 hours, we had the Americans and the Fed come out with data, the GDP number was out, the Europeans did the European thing, the Bank of Japan sort of shocked everyone later on today. So we got a lot of great things to talk about, and why don't we just get going here?
Yeah, we've got, interesting enough that we're here, we've had a cabinet shuffle. Reshuffle on the housing front, if anyone's been following along. Interesting. So we talked about it on the Loonie Hour podcast a couple weeks ago, but there was the housing minister here in Canada, God bless him, wrote this op-ed, which we totally made fun of. It was just this is the biggest flaming pile of shit I've ever seen. And basically said, basically started blaming the opposition and saying, don't follow your housing plan. We've got this. Don't blame us. Don't blame the municipalities. He's now out. So unsurprisingly, Twitter destroyed him. I don't know who his PR team. So the housing minister for Canada is now out. But ironically enough, his replacement is a guy named Sean Fraser, who I would consider the arsonist in the housing file. He is responsible for our population growing 1.2 million people last year. So this guy just opened up the floodgates. We already had a housing crisis, a shortage, I would argue. And so he opened the door to 1 million people. He's now in charge of the housing file. So
you're going long housing, is
Well, the arsonist has become the firefighter. And I just don't think you can script this enough. It's really amazing. I think these guys And again, I'm not trying to get political, but like these guys they can't get out of their own way.
Yeah.
Who's running
The show.
PR team?
Well, I'm sure there's a few realtors here tonight, and you guys are happy, so it's gonna.
But no, but Steve, you were gonna tell us how you were gonna change your mind about something. I think you should get into that.
Yeah, so I mean, everyone wants to know on the housing front to think like, if you're day trading houses, I think I've done a pretty good job. I know most people aren't day trading houses, but there was a conversation that we had, which was, what was it, January? I said, I think this might be the bottom.
You called the bottom.
And
Come on,
we had a really large rip, and I'm ready. I'm pulling a Tiff Macklin, and I'm unpausing. And I'm thinking that we might have potentially another leg down now.
So what are the drivers there for you? We know what the positive drivers are, which is the 2 million people, 3.14% population growth. But what's changing your mind?
I think the big thesis is like coming into this year, right? Like mortgage rates towards the end of last year were 5.5%. Everyone's panicking. Rates are still going up. Tiff Macklin comes out in either January or February, says, listen, we're done. We're going on a pause. Mortgage bond yields start to fall. You get your fixed mortgage rates down to about 4.6, 4.7%. Everybody feels good. It goes from 5.5 to 4.7. It might go down to 4.3, 4.2, and we're back into the threes at some point later in the summer. And everything looks good, feels good, and we can get over this. And now all of a sudden, we've had TIF unpause, so 2 rate hikes. You've had bond yields pushing higher, which we're going to get into tonight. And you've got mortgage rates back in the 6s, and I've had conversations today and yesterday with several of the large Canadian banks telling me that as of tomorrow, Friday, we're raising our fixed rates again, another 15 basis points. So, 2 of the big 5 Canadian banks, so the others will follow. And so, now we're pushing up to 6.10, 6.15, 6.20.
Can you tell us a story about your friend?
Yeah. So the big thesis, I think, is ultimately that, it is proving to be surprising that rates are going back up. And then I think that this is ultimately, it's rates are too high.
I disagree, but keep going.
But I'm saying like 20-year highs in rates.
Yeah, but from zero, dude. You know my feelings. Everyone knows my feelings.
I'm saying, like, look at house prices today versus 20 years ago, and you have the same mortgage rate.
Yeah, and higher debt levels.
And higher, it doesn't work. And so, like, the thesis, I'd say, like, coming into this year, it's like, okay, well, if you're down to 4.7, 4.6, 4.5, you can probably get out of this and relatively unscathed. And now you're going back up, which just means ultimately higher for longer. So maybe rates come down in 12 months from now. But ultimately, there's a lot more pain. So, I had just numerous conversations, and I know there's a bunch of realtors in this crowd. They can probably attest to this. But, I had a conversation today with a friend of mine, and she calls me. She's a little bit stressed out and says, what should I do? I had a variable rate mortgage. I'm by myself. I've got a 1-bedroom condo. I've got a variable rate mortgage. I was paying $1,500 a month. I've got a TD floater. I'm now arbitrarily been raising my payments. The bank's saying you got to lock in, but you got to do it by Monday. And we've held a rate at 5.4%. You have until Monday. And she's like, what do I do? Do I lock this in for the next 3 years at 5.4, the highest rates in 20 years, and my payment will go from $1,500 a month to $2,700 a month? It's a lot of money, $1,200 for a single individual living in the city as their grocery prices are going up, as their cost of living is going up. And so I just said to her, it's like, well, you start multiplying this across an entire country. I think I would argue that she's in her part of her career where her salary is going up. She's ambitious. She's going to continue to grow. But I said, what about a family of 5, 3 kids? Blue collar worker, where you get an extra $1,500 a month plus your food bill, it's not going to work. And so my thesis is ultimately that I think right now what we're seeing is housing is slowing down materially, and what's underpinning it is a lack of inventory.
So there's a lot of things in there to unpack, of course. So I mean, from the housing perspective, is this just, you said you're going to have a pause for this?
I'm unpausing.
So you're on, for God's sake. So you had a bottom in March, now we're at a high. We go lower again?
I think prices since basically January have ripped about countrywide. You're up about 10%.
So anything to do with realtors taking August off? That's going to pause? No. But you know, I hear this, and so then you have the real estate market, of course, is one part of the conversation. And you know, for us, we always look at it more from an aggregate level. So you know, it's a lot more things in life than the housing
How
market.
dare you? I disagree.
But if everyone now has to allocate more of their discretionary money, like whatever they're taking each month, towards housing, it automatically means there's less money available left over to buy other stuff. And we're going to go a lot deeper into this as we have the conversation further. Because I think we're now at a point where not only is, you know, just the Canadian housing market being affected by this, but the rise in interest rates is going to have this incredible, like, profound impact on what households are going to start doing. And they started a year ago, and they'll continue going forward. Same with companies, corporations. And then what they will be doing, of course, and they'll have less money available to spend, or they have to bore more to maintain their spending. But that gap that's going to happen, it has to be made up by somebody, and that somebody will be our governments. So we should be prepared to see governments borrow even more. And if they're not able to borrow more, it means they have to raise taxes. So we have to go with the City of Toronto request. It came out a few days ago as well.
Yeah,
But it's all tied together, and that's one thing that we love with our conversations. You know, we always start with housing. I won't go into the...
Well, no, for those that aren't aware, the City of Toronto basically asked the federal government for a bailout. More or less, they said we need funding. We're essentially bankrupt.
Hands up if you heard that story. I can't see anything.
Yeah, I can't
so
see
assume-
anything.
We assume someone did.
I saw one or two hands. I feel like it was more.
You know, it might be a bit political motivated, you know, what was happening there. And you know, the response from Ottawa was actually the correct response. Because, hey, if you need more money, you know, at the city level, municipality level, you have to ask your province first for money. And then if they can't get it, then, you know, then you come up then.
But what's wrong with the province of Ontario?
It's beautiful. There's nothing wrong with their finances. But it goes back to if they need money, especially at the municipality sector, like where do cities and towns get most of the tax revenue from?
I don't know.
Well, come on, we'll let Rich answer. You know this one.
What do you mean, property taxes?
Yeah,
Corporation?
property taxes. Yeah, that's where both.
But property taxes are very low in Canada relative to other jurisdictions.
Yeah, but if
In
you're
the U.S., sorry, I didn't interrupt you, but in the U.S., it's, you know, you have certain places like Essex County, which is one of the richest jurisdictions in the U.S., and New Jersey. You have property taxes of 3-4% on the average house price might be $3 or $4 million. That's why they have such excellent public schools in those jurisdictions.
What are their income taxes?
Income taxes are high also in the Northeast.
Not this high?
They're very high in the Northeast.
Close.
Yeah, but anyway, but also you can get into the SALT tax, which is the state and local tax deductions on your housing. But in Canada, property taxes are relatively low, which is one of the argument. You hate all kinds of taxes. I
don't
tax
like taxes.
assets,
But however, if you're just saying you're paying $10,000 a year for property taxes, and then all of a sudden that goes up to 15, right? That's an extra, you know, $5,000 that you have to come up with. And it goes back to your story, you know, about your friend, where they have to make that decision on the mortgage side. So it all comes down. Everybody needs more money today to keep this, you know, this game going.
But this is back to this.
Yeah, but this is recurring. It's like this is like not just like, it's not one person. It's like, and you know, the conversation I had is like a lot of people, when you talk to people at the bank and mortgage brokers and what their conversations are, it's like there's a cohort, people are panicking, and there's a lot of people that are panicking like I gotta lock in now. I can't take a lot of it is like I can't take any more pain. Like the psychology of it is like not knowing like what, like how bad it could get. Like maybe we're at 6 today, maybe it's 7, maybe it's 7.5, and I mean that's not my base case, but like I think that's what people are having those internal discussions, and so they're locking in, and so that's just going to ultimately pull from discretionary spending. It's the same conversation I had today. It's like I'm just going to have to stop going to the restaurants a little bit more. I have to pull back here and there. So it's like if you multiply this across the country, like
Well, we talked about this. We talked about this early, which is the same as wrong in our business. But we talked about the Great Rate Reset, right? So there's certain economies in the world, which is new. If I can run off the top of my head, normally I have my computer in front of me so I can cheat. But South Korea, New Zealand, Australia, which is almost all variable rate mortgages, the UK, which is very, very short duration mortgages, Canada is one of them, and you have maybe half a dozen other countries where all your mortgage lending is basically at the front end of the curve, right? You have short end, long end, and we talked about the Great Rate Reset. And as these mortgage rates started to ratchet up, we talked about the reset and how people would be feeling the pain. And like I said, we talked about this way too early, which is the same as being wrong. But I think it is now finally starting to happen. And your story is, I think, really indicative of that.
This episode is sponsored by Greater Vancouver Tenant and Property Management Ltd. Looking to rent out your home or property? Greater Vancouver Tenant and Property Management Ltd is here to help. With nearly 500 Google reviews, their property management team loves working with first-time and small landlords, providing best-in-class rental and management services right here in Vancouver. Condos, townhouses, houses, multiplexes, the team uses technology and industry best practices to avoid the usual headaches. To get your first 2 months of management free, text or WhatsApp the word BOOMER to 604-256-6930. That's BOOMER to 604-256-6930. That's a special offer for Loonie Hour listeners. I personally use them myself. Highly recommend. Check them out.
So what's really great about this conversation, first of all, I actually have some numbers for a change without a computer in front of me, so I know you won't like that. But yeah, you're on your notebook. But from a pure investment perspective, and when you're managing money, you just have to be objective, and sometimes it can come across as the wrong way, as being insensitive and whatever, but that's the view you have to take when you're managing money. So when Steve, you just mentioned all this is happening from an aggregate perspective, it's not like in 2015, oil prices dropped from 100 to 20 bucks basically, and that hurt Alberta a lot. Didn't hurt Toronto at all, not a big deal. From an investment perspective, when you start having this, this enormous cycle that is starting to turn, it's affecting everyone at the same time, it actually gives you a better perspective or vision on which way markets are going to move. So this is what we're excited about now. Gives you an idea like where are we going to go, where are we not going to go. Now for the data. Right?
Oh, for which who?
So I got my data points.
Oh, okay.
That's the only one.
Is that something written on your hand?
No, nothing there. So the world has about 300 trillion in debt right now. And how many zeros in 300 trillion?
12. 14. 15.
A shirt or something.
Don't throw one.
I did.
Don't. This guy's trying to throw a mug. Everybody knows.
Don't throw the mug.
Who said it? Who came up with the number? Someone come up and get a mug.
I'm the one who said it.
No one wants it.
We got a mug collector here.
We had it. There you go. How many zeros? 19, 20. Okay, so we have $300 trillion of debt in the world, and the accumulation of this debt has been amplified from having zero rates for over a decade, and governments especially just running deficits, so you need more debt to pay off the previous debt and so forth. About a third of this debt that's outstanding is on either a variable rate loan or on short term, so it's coming due very, very quickly. So when you start crunching the numbers, Rich.
Thank you.
Yeah. So assuming now, like we've gone from 0 to 5% for overnight rates, so 3 in Europe, 5, in Canada, the US. That means there's about $3 to $5 trillion in additional tax revenue that's needed to pay the interest burden. So you see where we're going. So we've gone from, your friend who has to pay an extra,
Well, it's $1,200.
$1,200 a month. And so the governments, we are at the end of this, super debt cycle, and I believe in this great reset that's coming. And it's not a believe. I think if you look at the numbers, like it certainly suggests we're going down.
Tinfoil hat over here.
No, I don't have a tinfoil hat. It's just the way we're going. But if we're going down that avenue, households will pinch their belt tighter. So if you got to pay an extra $1,200 for your mortgage, you don't go to restaurants as much and things like that. If a company has to reduce their spending elsewhere because they have to allocate more money to interest, they'll do it because companies are, it's a living entity that is always a profit-seeking strategy. That's what they do. So to keep growth growing in the world, by default, governments, they have to fill that void. And the way the governments will fill the void, again, they have to borrow even more. So, but now, of course, we have this challenge where it's taken increasingly more debt to produce that exact same dollar of GDP growth. So, Rich, you talk about quite a bit with productivity.
Well, there's two ways to solve that problem.
Here we
One
go.
of them you don't like at all.
One is wrong.
One is as old as the Romans, which is, so anyway, the key, sorry I'm interrupting you, but the way, how do you deal with it? How do you deal with all this debt is really the question. Keith says taxes, raising taxes. The other way is to do it is through inflation, inflating that debt away, which is, in my view, when I say it's as old as the Romans, I mean when Romans were minting coins 2,000 years ago, eventually they started to overspend because they weren't expanding as much, and then they started to literally shave the edges off the silver not pennies, obviously, whatever they were called, the Marcus Aurelius coins or whatever it was, but they would literally shave off the coin, and that's basically you're devaluing the currency. You do that enough, and you eventually inflate your debt away. And then there's another way you can do it, which is if some aliens drop down from outer space and magically...
They're already here.
But yes, maybe.
That was the other big story, right?
Oh God, no! Please, let's roll
I need
this
a
back.
T-shirt. I have a T-shirt with an alien UFO on it.
I'm saying if you, not from aliens, if you increase your productivity growth, you can deal with this debt. And so those are really the only.
So ChatGPT's going to step in.
So ChatGPT or aliens, Steve.
So ChatGPT, aliens, or inflation is basically
The only way to do it, or really you raise taxes, which is Keith's point. But there's a counterpoint to this. If you do have drags on consumers, which by the way, it's not clear that that's true for everybody. In the U.S., debt to GDP is back to a 20-year low. The government is non-constrained because they're the reserve currency in the world. Non-financial corporate debt is also different because so much of that is fixed rate, and I think interest payments are actually, relative to their actual revenues actually very low. So different countries will feel that squeeze in different ways. Canada, I think, is kind of screwed from that perspective. We'll talk about that a little later. But yeah, I was going to finish just saying, but go ahead.
No, I was going to say, we're going to get to inflation, but finish up your spiel.
No, I forgot now what I was going to say.
Well, Rich is right, but that's the academic perspective.
Okay.
You can inflate your way out of a debt problem. That's what we learned in school.
Well, it's empirical. You mean to say empirical perspective, as in we've seen the evidence of this happening time and time again.
But we've also seen evidence of it not working, because we just had a decade with zero rates and QE. They're doing everything to try to create the good inflation. So a good inflation is when demand is really strong and supply is a little bit behind, maybe something like that. What we have today is a supply problem. I mean, the Fed, the ECB, they can't produce more wheat. They can do whatever they want with rates.
They have not invested enough in commodities.
They're not. Yeah, it's really tough. So you've heard me use the phrase before that I think risk has been synchronized around the world, and this is another example of it. So I think we're living out in this period of extremes. So we just had one extreme moment. Now we've gone to another. So gone from 0 to 5% overnight for the Americans with rates, I think 5.25 now for the Americans. You do that so quickly, and the Canadians did it, and the Brits, the Europeans, Japan might try to do something in a few hours. We'll see. But again, it's going to trigger this moment where entities who are seeking to maximize their profit all the time, which are corporations and a household. You may not think you're trying to do it, but we are. They're the ones who will react, and governments will react in a very different way. And as this goes, we go down this, the sovereign debt crisis that in our mind it's coming. The after effects of it likely won't be expressed in the government bond world. because the Bank of Canada will jump in automatically and try to protect, federal bonds that are being issued by Ottawa.
And provincial.
So instead, it gets reflected on the currency side. So again, there's lots of opportunities.
I think we should go down that rabbit hole, because you had Canada's CPI inflation came out, last week, 2.8%, below expected 3%. Everybody's all excited. The finance minister, Chrystia Freeland, comes out, sends out a big tweet, says we're the lowest inflation in the G7. We're doing such a good job. We're making life more affordable. Not her words, not mine.
Still positive.
2.8%. The damage we know the damage has been done. And like almost like literally, like I said, I'm happy that inflation's coming down, because it's gonna relieve hopefully a lot of pain. But I was like, man, this tweet feels like it's gonna top tick inflation. And sure enough, commodities this month are up 7% as per the Bloomberg Commodity Index. Today we're watching the markets as we're preparing for this show. Canada 5-year bond pushes past 4% for the first time in 2 decades, and that's why you've got your mortgage rates going up tomorrow. And your U.S. 10-year yield moves up 15 basis points on the day, the single largest move this calendar year. And all of a sudden we're back to the races. And so we've got, we're not out of this.
No, we're definitely not.
But
We're definitely not.
What's the race? What are you?
the race to get reelected.
I wouldn't.
But
I'll take the under.
No, some interesting data here. My view has been that these higher rates, ultimately, you talk about my friend there earlier tonight, this is going to filter through. It's going to take some time. I think it's taking longer than I expected to, but if you multiply this across the country, ultimately that's going to create lower growth, weaker demand, I think some disinflationary trends, but it's going to be a struggle, I think, to get there, and some pain along the way. And so if you look at, I don't know who's advising the finance minister. Certainly not my friend Ben Rabideau, so I'm going to read from his research note here that he sent me. So he goes on CPI, so headline CPI again, 2.8%. He goes, so even if CPI averages a very low 0.1% monthly increase for the remainder of the year, we will still, at the end of 2023, we'll end 2023 with a headline inflation back above 3%. If it averages 0.2% per month, which is 2.4% annualized, and that's more or less within the Bank of Canada's target, CPI will be back towards 4% by the end of this year. So you can imagine the headlines, again, if you're trying to get reelected, for example, you see 2.8, and you see 3, 3.2, 3.4, 3.6. And this is also the problem with base effects, Rich.
Yeah, we'll talk about that a lot.
But
that's why we're going to talk about the Fed, right, soon. But last week it was the Bank of Canada. They raised. And I think and then the market. So we talked about different ways that the market prices in or bets on the future path of interest rates. In Canada, it's called overnight index swap. That's what it's called, sorry. In different countries, you have different products, whatever. And Canada, they're pricing in that for the next 12 months, interest rates are actually going to go up slightly. So let's just say it's going to be flat for 12 months. It's very possible there's another rate hike that's going to come, but I don't know. Maybe
sounds like a Twinkie bet.
That sounds like a Twinkie bet.
A lemon loaf bet, please. It's better.
Should we?
There's some booze out there. You hear that? Booze for the lemon loaf.
Yeah, those people never had a lemon loaf. That's all that's going on here. But you want to jump into the Fed then, because you introduced. You want to give us a rundown on what they did and didn't do.
Sure, but I need my notes.
I do want to ask you. So the BOC is coming out in September.
Oh yeah, this is our Twinkie bet. We have to do the Twinkie bet. Let's do it.
You got one of these on the line.
Okay. Well, let's ask the crowd. Who thinks that the Bank of Canada is going to hold rates steady? This time I'm going to look properly.
September is the next meeting.
Oh, it's actually quite low. All right, so there's 3 options. Who thinks they're going to cut? Let's start over. Who thinks that they're going to cut? Nobody thinks they're going to cut.
One
I
hand.
like this.
Wow.
This is good. Okay. All right. Who thinks they're going to hold at 5? What is it? 5%? Yeah. Was that half? How do we?
Did you say a hold?
Quite a few holds
Yeah.
there.
Oh, hold.
Yeah.
I'm in for a hold.
Okay.
Was I supposed to bet now?
Yeah, sure. This is your bet.
Who's hiking?
All you guys have to eat Twinkies when you're wrong. Okay, I think they're going to hike. Who thinks they're going to hike? It's half. I like this. This is well priced.
I'm going to go hold.
You're gonna go hold.
But I've been wrong for a while.
All right. Well, I think that Steve, brother, you want to introduce the Fed then?
Well, yeah. So I mean, obviously the Fed. Coming into this week, this show here, Keith, we were like, man, and a week and a half out, we're like, this might be a boring live show. There's just not a lot going on. We got hit with all this information, and obviously, so the Fed hiked rates 25 basis points tomorrow. You and Rich were cuddling up in the hotel room.
We were
slugging back a pint, watching Jay Powell on TV.
We were watching
So actually, it kind of went like this. So I arrived on Tuesday night, and then Rich arrived Wednesday morning, and I get a text from Rich. He's like, Keith, I'm in the lobby, and I left my credit cards at my mom's house. Can you come down and pay for my room? I'm like, okay, sure. So I come down, and you owe me money for that, by the way.
Where's Keith Acton?
And Rich said, what do you want to do? Want to go for a bike ride? I was like, no, let's go watch the Fed meeting, the presser. And two of us were so excited. We run upstairs and then we do watch it. But do you want to go into the Fed data?
Yeah,
what they did?
Well, I mean, there's lots of stuff. There's so much shit we have to.
I get to the Fed hiked yesterday. The presser. I mean, I don't know if you want to quickly parcel that out and say, what was the? You guys watched the whole thing.
Yeah, it was great. He wore a nice tie. He, there was a couple of really stupid questions from the press, which is quite normal, I would say. There was a couple of good questions. I think for me, it was just, the Fed's raised to 5.25. That's a 22-year high. I'm going to front run Keith here. I think there's a couple of comments. I mean, normally the presser is not meant to, change things, or the press release is very, very, very calculated in order to not spook the markets. The two takeaways that I had was that he said inflation expectations remain well anchored. Now, we've talked about the word anchored before. That basically is from Mario Draghi, who was the Italian ECB, governor for many years before the current one. I won't even say her name. But so the idea, we've talked about inflation, that's one thing, but inflation expectations. And I think that was one of the main takeaways for me. And then the other one is something that, Keith, you've been on for a long time, and says to achieve the goal, which is below trend growth. You need below trend goal. Let's start over. To achieve our goals, you need below trend growth. And softer employment conditions. Now, softer employment conditions is one hell of a euphemism, and that means basically people fired out of employment, which means the labor market contracting and unemployment going up. I think you guys can pretty much figure that out. And below trend growth means exactly what that is. It means weaker growth. And so so to me, that's a very hawkish statement. And they said they were going to be data dependent or what have you. We're going to get to the GDP, which was really positive. But Keith, what did you have to say?
Yeah, we heard this. The great thing about listening to these central bankers, a lot of people are listening to it, and you come across with different things. You hear what you want to hear, of course. But specifically, Powell said, the labor market is very tight. They've been very consistent with this message now, even going back.
Tight means strong. Sorry.
Yeah, because remember, it was a year ago at the Jackson Hole, the Kansas City Fed, boondoggle they have every August. But by the way, guys, August is it's like the quiet month. There's no central bank meetings taking place. The Bank of England are out next week. I think it's Tuesday or Wednesday they're out. But then August is dead.
Tiff's at his cabin on the lake.
Yeah, but
sweating.
You get a bit more details what's coming out. But the Fed has been very consistent. Not only are they looking at headline inflation and other measures, but they've consistently talked about the labor market. And again, he specifically said the labor market is very tight. So that means that demand for labor is effectively equal to or greater than the supply of labor. And you always have mismatches in a normal economic cycle, but for them going from 0 to 5.25% in such a quick time period, and they can't put a dent in the labor market. So all I hear is, as you said, Rich, they need a recession, they need job losses, they have to reduce demand. And the other comment that Powell made, he said, to have inflation come down to the appropriate levels, his quote was, he said, it will take time. So they're not finished hiking rates yet. It seems like with the Fed, it is the most important central bank in the world. equity markets especially, they've been trying now for maybe 9 months to guess when the Fed they're going to not only pause, but really stop hiking. And they get the energy for it, and then it falls off, and then they start going again. But again, we're getting a very consistent message, from the Fed. And after they came out with that, then we had the GDP number this morning.
Yeah.
I think it ties in all together, right?
Yeah, I mean, GDP was stronger than expected. Rich, you'll dive through the numbers, but was it 2.4%?
Yeah, but you have to be careful. So GDP is calculated in different ways. Some countries do it monthly. The UK and Canada do it monthly. I think that's kind of ridiculous. Other countries do it quarterly, and they do a seasonally adjusted annualized rate. So what that means is you can't compare one season with a different season. Different seasons have different types of productivity and different types of product. And you do an annualized rate, which is just a fancy way of saying times 4. Right, you have 4 quarters, so then multiply it by 4. There's a bit more complicated than that. But the U.S. GDP growth was 2.4%. A couple of things that stood out for me. It was positive, so I think on the whole you can't, the expectations were 1.8, I think. And then, so a couple of things that stood out. One positive, one negative. Positive was that private gross fixed capital formation, that's a fancy way of saying investment, grew 4.9, so that's unambiguously good. That's after 4 quarters of contraction. So if you think about the chart, you had a dip, and then you're popping up. So there's something positive going on in the fixed investment world in the US. But the thing that stood out on the negative side was consumption was 1.6. That's an annualized rate. So what's 16 divided by 4? 0.4. Oh my God. So it's actually not that great after really good Q1. And remember, we talked about this before, is the consumption in the US about 75% of GDP. So if you don't have that consumption piece, it's very, very difficult.
We push back on that because on consumption, I mean, Canada's definitely in a much different situation than the US, but on the consumption side, credit card balances are growing. In the U.S. and more, per GDP, whatever. But in Canada in particular, I mean, not only is retail spending actually down on a per capita inflation-adjusted basis, so retail spending is actually falling.
Yeah. In the U.S., U.S. is it's a stronger economy. They have less debt to GDP in the households. Their households are not linked to we talk mortgage rates in the same way. Whereas Canada retail sales growth, whenever you see these positive numbers, you have to discount the fact they have such a huge population growth.
But all you see is these headlines, right? So it's it strikes across the CBC News. It's retail spending remain up 2%. Yeah. It's well, your your population is growing by 3.
Right.
First of all.
So I have it here. I have it written down for Canada. I wrote a bunch of Canadian notes so I wouldn't forget. But Canada's real retail sales per capita is up 3% in 5 years. So basically flat. Sorry, since 2018, so almost 6 years. It's crazy. That's crazy. Think about that. So the per capita retail sales is flat over 6 years, Keith. It's nuts. Sorry, you guys are carrying on. Uh-oh, we lost it.
How does this play out, Boomer?
You had me on retail sales.
No, so how does this play out, right? Because I think the problem that we're seeing is Powell's talking to the labor market and saying, okay, we've got to crack the labor market. Rich is the data geek here, but ultimately, it's the most lagging economic data. So it's basically, I think from a political standpoint, is they're waiting for the most lagging indicators to roll over so they then have some air cover to say, okay, we can take our foot off the gas. So you're waiting for this lagging data to basically roll over.
That's true, but the U.S. labor market is strong. So I know I'm talking out both sides of my mouth here a little bit, but it is. I've always said the labor market's a lagging indicator. You can't predict anything on that. It is the last penny to drop. But genuinely, they have a very, very strong labor market. We looked at continuing claims. That fell a lot. It's back down to a 6-month low, whatever. There's something called the Challenger Job Growth cut announcements. So you remember in January, it shot up. It's starting to roll over again.
What are the JOLTS? What does JOLTS mean?
I don't know.
It's job opening, labor, turnover.
Keith, I'm curious. What's your?
I think first we need to maybe step back and explain, because some people may not be aware. So when the GDP number came out this morning for the Americans, it's a great number. It says there's no recession, everyone is working, making money. And the equity markets, after a while, they sold off aggressively at the end of the day. That the bond market tanked. The U.S. dollar just surged. And a surging U.S. dollar is not positive. It's a sign that foreign capital is running in to basically the treasury market, short-term market, for safety and protection. And it might seem a bit counterintuitive because here we are, it seems like, we're disappointed because we have some really good growth numbers, out of the US, and the market is selling off. But the reason the market is selling off, because it then applies, if you reconcile that with what we said earlier with Powell and the Fed about continuing to raise rates, it just gives further evidence that rates will continue to go higher. And how much higher, we're not sure yet. They said, well, we're going to be data dependent, and so they're definitely going to do another quarter point hike coming up in September, most likely, and it could be even more after that. But the markets, they don't want to hear that. They want to hear that, hey, no more rate hikes, because we know we can't, but we don't want mortgage rates to go higher, using the Canadian perspective on it. And but I think once we finish with the Americans, we'll jump over to the Europeans. Because this morning we wake up and yesterday Fed was Rich was excited with the Fed meeting. Yeah. And this morning we had the Europeans doing their exact same meeting.
Fantasyland.
I know it's the economic Fantasyland. It's called Europe, but it goes back to the concept that everyone is now reconciled. Everyone is in sync. Rates going up. Is growth going to roll over or not? And what will the effect be with on interest rates? So do you want to go through the ECB?
I know you pull your popcorn and watch the guard there. So
This episode is sponsored by Canadian Western Bank. Canadian Western Bank knows that to truly serve business owners, you have to think like them. You have to know their struggles and live their triumphs. CWB's founders were entrepreneurs, and when the kind of bank they needed didn't exist, they built it, because Canadian businesses need a certain kind of bank, one that's there for every turn, every peak, and every unexpected drop, one that's actually easy to work with, a bank completely dedicated to business owners. It's why business owners love banking with CWB, and you will too.
So first of all, the Europeans, they raised rates by 25 basis points. That was 100% expected. There were no surprises with it. So whereas, the Canadians, Americans are at, roughly 5.25, the Europeans are now at 3.75. Remember, they were at 0. And before they're at 0, they're at negative, right? That's why it's a fantasy land. But one of the surprise notes that came out this morning that not only shocked the market, but it really ticked off the commercial banks. They reduced the rate that European banks were getting paid on their reserves held at the ECB. They reduced it to 0%. So that's and you say, well, why did they do that? Because they want to help the banks build up their their buffers again, and that's one thing that the Americans did a really good job with after the housing crisis back in 08, 09. But so they did this, so that that takes off the banks, and now they're not getting paid anything for holding money at the ECB, which then forces them to do something with the money. So now your option is do nothing and get 0, or you lend it out and get something. However, what also came out from Europe the past few days is that there's been a severe drop in demand for corporate debt across the Eurozone. Now, I assume the EU as well, when you look at all the numbers pushed together. So this is again, when you look at, the Germans are in recession, services, you're starting to wobble, you like to use, that word as well. Manufacturing is getting weaker. So here's the ECB. This is where the Fantasyland thing comes in. They're raising rates to try to reduce demand and stop inflation. At the same time, they told the banks, we're not going to pay you any money on your reserves, so we want you to lend it out to keep the economy going.
I have a number for you.
Are you following?
I am.
The bouncing ball is going.
The mortgage loans, by the way, have contracted to 1.3% and falling. If you look at it's absolutely crazy. The chart.
This is in Europe.
Your area mortgage loans year on year.
So I can tell you, in Canada, residential mortgage credit growth will probably be touched. Well, in the next couple months, you'll hit about 4%. Yeah. 4% growth in residential mortgage. So that's equivalent to the announcement when they brought in the mortgage stress test back in 2017. And then in 2018, the market kind of rolled over, right? If you got no residential mortgage credit growth, pretty hard to see rising house prices. Yeah. Basically tells you people aren't really borrowing. And so you're on pace to hit about 4% here in the next several months. And so again, that's on pace with the announcement and unveiling of B20, the mortgage stress test. So people basically, again, it's 6.2% mortgage rates. obviously people are reluctant to borrow.
Yeah. It happened. Sorry, I know you keep going, but in China, it's the same thing. You see different measures and different practices. In China? Excuse me. Sorry.
China?
I hate that. China has a really big issue with their real estate market, and they've been cutting the price that they're paying to the reserves for Chinese banks in order to encourage them to lend. That's not working either. So Keith, you want to keep on in Europe?
I mean, so again, with Europe, and this is where things don't make sense. So they're hiking rates, which they want to restrict the amount of capital available to go through the economy. Then on the other hand, they're telling the banks that we're going to penalize you, so you need to lend money out if you want to make money. So
But ultimately, it comes down to
it's so contradictory. But of course, the market reaction to euro has been under a lot of pressure over the last 5 days, and like this morning it just got smoked again in line with everything else. But right now, as of this morning, a short change at the end of the day, but right now the market is sort of 40% expecting the Europeans might hike one more time, and then they're done. So you see, we're getting this point where, are we at maximum pain yet? Everyone is aware of it?
No, I don't think there's
But it still hasn't happened.
Yeah, exactly. There's more pain to come, for sure. Do you want to talk about the UK? Because the UK is also raising rates, and the UK is also under pressure, and they raised rates a couple of weeks ago. Or was it a couple of weeks ago? Yeah.
I mean, so we like to make fun of the Europeans, but what's happening to the UK now from a monetary perspective, like it would make one of these classic British comedies that they do.
Well, yes, Prime Minister is an amazing show. If you've never seen it, you gotta watch it.
So the Bank of England, in a time span of maybe 4 months, I'm guessing, they've gone from forecasting a severe depression happening in the UK to, well, we're growing too fast, inflation is going through the roof, so we got to hike aggressively, to now inflation is rolling over. And to give you an idea, again, like how countries are the same everywhere. And so the Bank of England, they're still indicating they want to hike rates. They really want to, crush inflation. And who comes out publicly and tells them, you cannot raise rates anymore. This is too much, for all of us to handle. So it's the Treasury Department. So you constantly got this fight going on between Treasury. So, they're the ones collecting tax revenues and having to borrow. And then you got the central bank, they're trying to slow things down. But so the Bank of England are out on the 3rd of August. So I don't know what day that is next week, and we'll see what they do. But right now, market is expecting 75 basis points more.
Come on, in one day?
No.
Shock the markets. Yeah, that's right.
Yeah, that's what I would do. But that's get mad when I say that. Any other comment on?
So they're expecting 25 then.
Well, I think the UK.
Yes.
I think the UK is different. I think they're all related in a sense, but the UK is different. I mean, you have a wage price spiral. I think in the UK in the way that you don't have in Canada. So nominal wage growth in the UK is 6%, 6.7%. Wouldn't that be nice here? I think that and you look at services, which is what I think they're. A lot of the talk about why headline inflation's come down or why core inflation's come down. That focus, I think, is misguided. It's often a lot to do with energy prices, energy price services. You have a big drag, you have a huge fluctuation, and that huge fluctuation times the contribution, like the weight, equals your contribution. And so what you're seeing is you've seen a collapse in goods prices, and that's dragged down headline from the peak. But if you look at the housing component, and you look at services in Europe and in Canada, well, Canada a little bit less, in the US, they're all continuing to go. So, we might not like the method, we might not like the tool, but I kind of understand why they're saying that there's still inflationary impulses out there.
Well, I think the biggest thing is like everybody in this room is kind of like, okay, you guys have moved all these different markets, and like, what does this all mean? Like, where are we going over the next 12 months? How do I position myself? What am I supposed to do? Like, I do wonder, like, rates are going up. People can't really afford it. People can't afford it. Businesses can't necessarily afford it. The ECB is raising rates. They're telling banks to lend money, but nobody wants to borrow because rates are too high. In Canada, your M2 money supply, your money supply growth is actually negative. So it's actually contracting. So the big, the inflationistas out there that are like, oh, listen, they're going to have hyperinflation because M2 growth was running at 20% during the pandemic. It's now falling. It's negative. And so are we on the precipice of this like credit crunch? Like, what is your outlook or view on the next 12 months? Clearly it's going to be a bumpy, volatile ride. You've got all these like media headlines, mainstream economists, everyone's saying soft landing. There's not even a recession anymore. You're just raising rates to infinity, and there's no recession, and bond yields are back up, and there's no hikes in sight, or there's no cuts in sight. So you definitely have a view. Come on, don't hold back now.
Yeah, you go, Keith. Age report.
Mr. Great Reset. Where are we going?
Yeah.
Yeah, so this is where you say something and then you get attacked, canceled. I suspect the best case scenario the next 12 to 18 months, and this is very positive, by the way, is that we have slow, muted growth in Canada and elsewhere. That's what you want. And then hopefully during that period, there will be dislocations and it will happen, but it won't be this fire sale kind of event. And once that happens, then maybe you get some adjustments taking place. Maybe there are some major changes with government policies will take place as well. I think that's though the best case scenario. The likely scenario is that we won't have this low growth period, in that we'll have some hiccups along the way. So whether that's like -1, -2 on a GDP basis, I don't know, or maybe employment growth just goes to 0 or things like that. But the biggest risk we have right now in Canada, and there's lots of reasons suggesting this won't happen, but if we get a stress on a national level, on an aggregate level, Canadian banks will absolutely start to contract with their lending. So even though you might see rates come lower, I don't mean the Bank of Canada will cut rates, but the yield curve can shift lower. I suspect Canadian banks will start to become reluctant to start lending. So you can actually have mortgage rates go higher in this situation. So one of the key things we're looking at right now, we'll have the Canadian banks coming out with earnings now in a few weeks. And so we really enjoy, like we look for it all the time, is how much are the banks setting aside for provisioning for bad loans or credit loss provisions, and that will give us a signal. But again, best case scenario, like we're there, because I think we've reached the peak level. People don't have enough money coming in anymore.
Well, the bank regulator, funny enough, is saying that now, finally, we're going to force the Canadian banks to hold higher, basically more capital against your variable rate mortgages. So again, people that aren't paying back not only their interest, but their principal. They're not paying down any principal. Their loan balances at some of these banks, your mortgage balance is actually growing. OSFI has finally come out and said, listen, you're going to have to hold more capital against that. And so they're trying to discourage that. So apparently, the rumor is in January of this year and the new year in 2024, these fixed payment variable rate mortgage products will cease to exist.
Just one more comment. We love to find little, tidbits. That's the donut thing, right?
Tidbits.
Yeah, I don't mean the donut. I want to find little clues, and so something to give you an idea, like what to look for and things, and they don't come up very often. When they do, they should scream at you. So this morning, it's called Home Equity Bank. So they do what do you call it? Inverse mortgages?
They call it chip reverse mortgages. Basically, like your.
What do you explain what they are for everybody?
You basically are borrowing against the equity in your home. So if you're retired, you've been in your home for 35 years. You've got obviously all this equity that's accrued, but you don't want to sell. You don't want to move. You don't want to downsize. You want to stay in your home. You can essentially borrow against that equity.
So what this group announced this morning. Through one of their different structures, first time they're doing a pretty large bond issuance coming up. The last time they did one, I believe it was oversubscribed 2-3 times, so lots of demand, and that's another story as well. But I see this and I say, okay, why are they borrowing? Why are they having this very significant bond issuance now, like today and next week? And you have to look at it from a company's perspective. And one thought is maybe it just makes sense. It's the cycle that they need the capital, or maybe another one, which is because I'm skeptical all the time, is that they foresee that maybe there is a period coming up where it'll either be more expensive for them to borrow, So credit spreads are widening, or there's a challenge in the housing market somehow, which confirms your brilliant call earlier.
Unpause.
I don't know what that means though.
You're about to find out.
We will. But, or they're concerned that they won't be able to borrow themselves at some point. So whenever you see companies do a big move like that, set it aside and, follow it all the time. And anyway,
Yeah, but credit spreads are still relatively muted, no? And that's like the big...
Well, it depends, right? So in the U.S., I look at the corporate credit market is much deeper and wider in the U.S. We talked about this last week. If you look at the credit spreads, they haven't come in at all. Remember we talked about, the S&P 500 is what the series we always look at, the U.S. equity market, dominated by tech. Obviously, it's like 25% of the U.S. equity market is tech. But as the U.S. equity market rose, and I think we hit 4,600 a couple days ago, the spread, normally you have a commensurate decline, so less risk, less, worry about refinancing, and that's expressed by a smaller credit spread. So what is a spread? You have corporate bond prices, and then you minus your government bond price of the similar duration. You always want a duration match, so that spread. And we have not seen a commensurate decline in that spread, even though the equity market goes higher and higher. So you asked me for an outlook. I think plus ça change. It's like the cycles don't die of old age; they're murdered, and they're murdered by the Fed. And I don't think it's going to be any different this time. I think that because the labor market is as strong as it is, and because the housing market is as strong as it is, I think you get to continue to get hikes, and those hikes are going to create some kind of schism, and it's going to be, you've said it in the corporate credit world, I think it'll just be eventually just a reduction in consumption. And what I'm looking at right now all the time is earnings revisions ratios. And 6 months ago or 8 months ago, so again, when you have analysts, they look at different stocks, and they predict what is going to happen to earnings or sales or margins or capex or whatever. You aggregate those analyst expectations, and you have earnings revisions ratios. And that doesn't always work like this, but the previous cycle, from that 30,600 on the S&P, you had the earnings revisions bottom, which means all the analysts started to say, hey, these companies are actually still profitable. And what we're seeing is now the other side of it, where the earnings revisions are starting to soften. At a time where the Fed has said they're going to continue to keep rates high and raise them, at a time where consumption, we talked about the GDP growth numbers aren't so hot, and at a time where I think that you're eventually getting weakness in the labor market. And so that's sort of my view on that. But as far back to your point about the spreads, I don't think they've come in that much at all.
So you're of the view that the labor market remains relatively strong, housing remains relatively strong, and so this is an impetus or a reason for the Fed to continue to push.
Yeah.
And by pushing, obviously, you're going to create more problems down the road.
Yeah, I mean, you asked for outlook for economy and outlook for risk assets and bond markets is always sort of different. The economy sort of lags. The equity market tends to be a discounter of future cash flows. So the equity market, or in some cases the bond market, is sort of the predictor. So it's, in a sense, what we do is circular, right? We use lagging economic data to predict what's going to happen in a risk asset that is meant to be sort of a forward-looking indicator. I mean, you can turn yourself into a pretzel sometimes. But the point is, I think that we've, on lower margins, weaker growth, higher interest rate costs, issues with China, issues with Europe, it's very difficult to see, I think, for equity markets, risk assets in particular, to have a really good run going forward, especially on weaker earnings revisions and on tighter credit conditions. I have a really hard time, which is why your point about the bond market being expensive, well, what if interest rates fall 100, 200 basis points? Then a lot of these debt burdens become a little bit more affordable. Back to your point about the debt.
So I just talked about this new bond issuance that's coming out. So it's going to be, the company is BBB rated. So it's investment grade, but one notch below, and things get a bit dicey. People may not realize how the bond world works. So there are excess savings around the world. So people might think, why is everyone always buying treasuries? Because everybody needs treasuries. If you're a bank, you need treasuries. Insurance company, you need them. if you're international trade, or you're an offshore bank and all that stuff. But then you have other savings are coming to the market, and they have to buy bonds by default. So would you rather have a bond that's paying, say, 3.5% yield, when you can get a nice BBB rated bond that's juicy, and I'll make up the rate, say it's 4.5%. So it goes back to this credit spread, narrative that you were just sharing with us, Rich. So my fear now is, because we are getting, this cycle is getting long in the tooth, so to speak. I'm hearing it now all the time, in that people who are now a bit nervous about anything, they all of a sudden they're guided into the bond world. That's where they go, and they're always told, hey, bonds are safe. You always get your money back. Old people used to buy them, and they did well with them, and all that. But they don't realize that today's bond funds, they look and feel and smell very differently than the bond funds from years ago. So years ago, in the 90s, that the bond funds, all government bonds, they took on a little bit of credit exposure, corporate bonds, and that was enough. That's all you needed. But over the last 10 years, especially with rates being at 0%, a lot of these funds, they've moved out into the high yield world, or at the bottom of the rating in the investment grade world, like a BBB kind of issuance, or they've gone to emerging market debt and high yield debt. And if there's no bottom to the cycle, or a top, if you want to look at it from that way, then it'll be fine. You'll get your money out. But it's our concern today that people are being backed into these bond markets, and they think it's safe, where they're actually running into the house that's almost on fire. So these are the things to look at. So you talk about credit spreads, and it sounds like a great conversation from Rich and all that, because it is. But I always think about, okay, how does that work? How does that affect the market? And the challenge with most people, that when you say the market, you always think about the stock market, but the bond market dwarfs the stock market. Currency markets dwarf the stock market. And there's a lot of things that are moving here right now. So I'm excited about it, because I think there are ways to make money on it.
If you're looking for a simple and effective way to invest in the stock markets, broad market ETFs may be the solution for you. With ETFs like BMO's S&P 500 Index, or BMO's S&P/TSX Capped Composite ETF, you can easily diversify your portfolio across a wide range of stocks, giving you exposure to various sectors and industries. Say goodbye to the hassle of buying individual stocks and say hello to a convenient, low-cost, broad market ETF. Broad market ETFs come in many shapes and sizes, and their ETFs can be used to form the building blocks of your portfolio. Whether you're a seasoned investor or just getting started, these ETFs offer flexibility, liquidity, and low cost, which means more money in your pocket.
I have a vignette to add to this. Well, there's something, are people familiar with the grade inflation? Basically, you can't flunk kids in school anymore, no matter how badly they are at math or whatever. And so what you've seen is like the average graduating grade from high school has crept up from 60 to 70, and now the average grade is like 85%, because you can't fail anybody even if they can't read or write or whatever it is. There's actually a similar situation in the bond rating market, where you're having rating inflation. So let's say a BBB rated bond, so let's just say slightly above junk or whatever. I never remember the ratings. Anyway, you have so you have basically a bond that's not so great today, would have been considered junk bond 10 or 15 years ago. And so you've had the bond rating because interest rates have been low for so long. These companies who otherwise would have had a really shitty rating, their ratings crept up and crept up and crept up. And so these bond funds are they're pitched as investment grade, but that if you use the same models of 15, 10, or 20 years ago, they would actually had a much, much worse rating. And I'm sorry, that was...
It reminds me of a few years. So by the way, there were 4 bond rating agencies in the world, basically. And so you have the 2 American ones. You have S&P, and then Moody's, which is owned by Warren Buffett. Then you have the French one, which is Fitch. I think that's what it is.
If you say so. I don't know that part, but don't ask me.
And then you have the Canadian version, the Dominion Bond Rating Agency, I think it's called. And a few years back, when I was offshore, I was chatting with these guys. They had a money market fund, and it was rated AAA by S&P. And if it's rated AAA, it means it opens the market for institutional, like captive insurance companies to pour money and stuff like that. Because it's AAA rated, it's safe, right? It's great.
Yeah, like mortgage-backed securities.
And of course, you know, the ratings are purchased. You know, that's another story. But S&P were pulling it. They said, you know, there's things going on in there, and no way it was a AAA. And Moody's, they said, no, we're not touching this either. And I remember I was chatting with the guy at a pub. By the way, that's where all the investment decisions take place around the world. And I said, what are you going to do? Like, you guys are screwed. Like, you're going to lose all your money. And they said, no, we'll just get Fitch. You know, get the French guys. They'll rate it for anything. So, but the point is that a credit rating doesn't necessarily mean what it should mean, right? And that's the world we're in.
So to summarize, in terms of positioning, for everyone's here, they made their way here, like, what the hell do I do? Positioning, you're kind of, Rich, you're in the camp that, you know, you're trading here a little bit, but you're a little bit skeptical.
Disclaimer, I've been wrong for 6 months.
But you're skeptical of the next 12 months.
Yeah.
You're in a more cautionary stance.
Yeah. Although I've been eating some crow on the tech sector. But yeah, that's right.
Keith?
I mean,
Again, I'll give you credit. You've been very bullish on the Fed. You've been fairly bullish in recent months on commodities, which are now starting to show a bit of life. What?
Well, I mean, for our strategies, like we're never all in any single market because it's the investment world. As Rich said, like sometimes you're right for a while and then you're wrong for another while. We just continue to recognize that there are risks out there around the world. And we know that if that risk does develop, then if you're in the traditional kind of a portfolio that's out there, that you're going to get creamed. Like you're going to get hit pretty hard with it. So we just want to make sure that we have positions. So if you know anyone know a distribution curve, the bell curve? You, Rich. This guy here gets a mug. Is that the same guy from earlier? So you just want to make sure that you're able to have allocations to and positions to a market that if the credit event happens, you at least you're going to protect yourself and save yourself. Because I say this all the time as well. If you lose 50% in anything, how much you need, Rich, to get back?
100%.
100% to get back. And that's the world we're in. So for us, like the easiest market to protect yourself in right now with that, you want to be long the US dollar, but not necessarily long US dollar versus CAD, but long versus like euro, yen, pound, Aussie, like all these things. Because if we do get this event taking place, that fat tail event, you're going to make a lot of money on that position, but you likely lose it elsewhere. So like we're, again, like we don't go all in different markets. We've been doing a lot of commodities over the first half of this year, which is now really working out. We've been light on equities because we thought they would have come off. That hasn't by now, so we're missing out on that. But again, as long as if you continue to expect an extreme event could happen, just be prepared for it. That's all you need to do.
No, and I think on the housing front, just to wrap up here and clarify on like an unpause, I think just like as you get these higher rates and higher for longer, mortgage rates at 6%, I just don't think Canadian housing it doesn't work. The one thing I'd say, like in terms of time, so active listings in Canada, in this country right now, are half of what they were back in 2014, 2015. Half. So in terms of all the houses that are available for sale on the MLS as of right now, 50% lower than back in 2020, basically from 2010 to 2015, half.
So that includes condos and
condos. So think about all your new construction, all the apartments that have completed that are done. You've added all this new supply. You've added all these people to the economy. Half. So this is why when you say Bank of Canada comes out and says, well, housing has been resilient. Well, I would argue that it's not a strong housing market. There's not a lot of sales. There's not a lot of listings. But there's no inventory. So the people that need to buy, want to buy, people want to get on their lives. You got a young family, you're starting a family, you want to get on with your life. And And so you're trying to buy something, but the reality is again, 50%. And so I think, like, I don't think this is a strong market. I think that you've got inventory that is masking a lot of these issues. But ultimately, I think the higher for longer that this is, you're gonna have issues, and you're gonna have people that are going to foreclose and default and struggle to make ends meet.
I know I'm wading into waters that I don't belong in the housing market, but that's the problem I have though. If you just have as many people coming into this country, literally 3.14% is the highest it's been in 50 or 60 years. And we know housing starts are very, very low. Don't you just have a floor? Like, what's the catalyst? Like, in the US, the catalyst was, just the MBS market was total bullshit, basically, and they just, the collapse in lending. But what's the and we know that there's actually relatively few people who actually have mortgages, so there won't be the forced selling you got in Las Vegas or in those crazy markets, the Gully.
I agree, but there will be stressed people, and people unfortunately will lose their homes. Is it going to be enough to oversupply the market? I don't necessarily think so, but not to say that prices can correct somewhat.
But also that you're going to say, saying that you won't have the ramp up. Anyway, I know we're.
Well, I think ultimately, I just look at what we're seeing right now is units under construction still relatively elevated. The stuff that's in the pipeline is getting built because it has to get built. There's already a hole in the ground. But if you look at residential permits on a 6-month rolling average, it's the lowest it's been in a decade, and so people are obviously they're stopping construction. So it's ironic enough again that the new housing minister, was in charge of immigration, and hopefully he's as successful as ramping up housing starts as he is about ramping up immigration. But I think it's going to be hard because ultimately you have to incentivize private capital to put money to work in an environment where we're all talking and saying, this is going to get ugly. This is a bit of a shit show, but you need to put your money to work.
Yeah. But this is where it's confusing because I'm hearing a very positive story.
I think so
am I. Right? But if you're just looking at it from that perspective, you're 100% correct to see it that way. But if you look at household debt metrics for Canada versus other countries,
we're one of the highest in the OECD.
It's horrible. It's horrific. How much debt we have here. So again, maybe the challenge with us in Canada, it doesn't originate in Canada. It comes from elsewhere, and it doesn't mean that the market has to fall off, but the amount of debt that's been accumulated by households. Some people say, yeah, but it's mortgage debt. It's just that they swap out and all that's fine. But if that's the case, you would just continue to borrow forever. But there is a point in time. As Rich said earlier, you're going to start shaving the coin and things like that.
Well, it's not just. It's also not. So Canada. I have different charts that you guys can see, but there's 36 countries in the OECD. I think Canada has the 4th or 5th highest mortgage debt to GDP ratio. But that's only sort of half the story. That's like the stock of debt. The other part is the flow. So the interest burden or the debt servicing costs are going back to all-time highs. So you have it's sort of the compounding effect of much higher debt servicing costs, e.g., how much interest you have to pay on the debt you owe, plus the much higher debt. And if you do get the things like Steve's mentioned. I don't know. Like I said, it's not my lane. So
household debt service ratios can be measured. So either way, you're going to hit a record all-time high in the next couple months. But it can be split up into between interest payments, so household debt service as a percentage of interest, and then principal. So interest payments are obviously blowing out, and principal is just going like this, because obviously you have all these mortgages that are literally people are barely paying their interest, let alone any principal. So. But yeah, I think that's a great place to kind of wrap it up. I think, ultimately, I think the three of us are still in the camp that the next 12 months are going to bring a lot of volatility. And Keith's got his tinfoil hat on, calling for the Great Reset. So there you have it. Aliens, Great Resets, it's all coming to fruition. And that's a wrap.